Indexes rallied today after a strong sign that the economy is slowing, with GDP coming in at 2.6% versus 2.7%. And then we just had our little trading range where we were testing these levels. We never really got above the high of the day established early around 10:30, never even really got back to that level. Came back down, was hoping we get to that 440. We never did, but we are once again seeing massive divergences. Panic and euphoria is giving us a pretty clear signal. We're going to have to drill into this chart and see why the Nasdaq and the SPY, why are we fighting here, and why can't we push any higher through this neckline? Why did the banking stocks, specifically regionals, sell off in the last half hour of the day? Baba's news after the conference call was very different than what we heard on the conference call. Several names to go over, including VKTX, which we went over yesterday, which is up another 15% today. Hey everybody, welcome back. So we have a ton to go over, and we're going to start with the basics. This is the S&P Futures market, and we can see very clearly here where the low was put in on the 13th and how we've been acting since that low. You can see this almost cup-like pattern. Now, what's interesting about this is no matter what the news is, it doesn't really seem to matter. No matter what happens, all we get to see is we just very simply see this little cup. So we come down, we test, everything's going to fall apart. We lose one of the largest banks we've ever lost, and then all we do is move higher. So if we take a look at this, it's really hard to get bearish looking at this, right? But if you zoom out and you look at from an hourly standpoint, and you can see this somewhat of a W that is possibly forming, or maybe it's going to be an M. We don't know until we're over this 4180 on the futures market. But see how we tested this level and we've been fighting there and then we couldn't break it? That's something that's going to be really important, and we're going to talk about that in a couple minutes here. But just remember that we were unable to break there. We're coming across this line and we're just looking right at it, and 4085 has been very difficult for us to get above. GDP came out, we were looking for 2.7, came in at 2.6, so the Fed can have a victory lap over that. But you can see right here, triple. Now, most of these triples, they don't last. In other words, when you start seeing a triple top, they're pretty rare. You're usually breaking through a triple top. We talk about this, and I'll go through it again with VKTX today and how that was pretty clear that it was going to push there. But if you take a look at this pattern, and there was a triple top in intraday in VKTX, which just gave a signal. So if I look at this and I look at this level, I'm having a hard time saying that we're just not going to break it, when every single one of these days, all we're doing is just seeing higher highs, right? Or lower highs, I should say. And we are seeing higher highs as well here. But here we're seeing lower highs. So that's all we're doing. All they're doing is walking us up the entire time. And I think that's really important. I think it's very important for us to understand that this is what's been going on the entire time, that we keep waiting for the next shoe to drop. Now, if you look at the daily, all you're seeing is the S&P going sideways right here, right? Look at, we're just trading in this range. And we've been in this range from this red bar since pretty much Tuesday, February 21st, coming straight across, comes down, back into this range. So nothing's really broken here. You're just forming a bottom, and now you're closing at highs ahead of PCE tomorrow. Now, when PCE comes out, there could be two alternative theories that happen here. It could be good, meaning lower than expected, and then we could see a continuation rally into the end of the quarter, because tomorrow is not only the end of the PCE and the end of the month, right? The end of the data set, but we begin new earnings season in April. We're already jumping right into it. And what's interesting about this is the end of the quarter. So you might see a push for window dressing into this. Window dressing is when these funds go out and buy names that they really don't want to own at these levels, but they put them in so that people can read them in their prospectus. So if we look at that, we would feel pretty good about that. My larger concern is just that you're buying into PCE tomorrow. Now, if we just take a look at the cues in regards to the Nasdaq, you're already breaking out. We're already seeing, if we take a look up here in the left, focus on this level for a second. Bear with me. I'll put it right up here so you can see it. And just watch this line and watch the numbers that I'm going to show you right up here. And watch how this moves. See how it's 290 right in here, and see how it's dropping. And then all of a sudden, it just starts turning up just a little bit. Okay. See it right there? So that's the first time we've ever had a curling 200-day moving average since we broke and started coming in down here. It has not happened. So it's been over a year since you've had anything like this. And you're starting to see the 200-day curling up. It's really hard to play with a 200-day moving average that's curling up. So again, could we sell off? Sure. But that might mean that you come back down to 290 eventually or something like that. That does not mean that you're ever seeing these lows again. I think it's pretty clear that these lows are in. Now, there could be some kind of event that happens, but I'm not really sure what that's going to be right now. And I don't think anybody has a real clear picture on what would make us take out those lows again. Inflation and the Fed are starting to take a back seat to the banking crisis. And yes, he might raise rates again, but he's only going to be able to do it once more. And that's pretty much going to be the end of it. And a lot of people don't think that that's going to happen. And I just want to reiterate this. Yesterday, we talked about this sell signal and how it's only been 4 times since November 2021. 1, 2, 3, 4. Pay attention to this or don't pay attention to it, but do it at your own caution. So the reason I say that is it's not a guarantee that you're going to roll. You could absolutely trigger right here, bounce around, and then you could break out. It's happened before. It's a little harder on the indexes because there's so many names. But until I'm over this line right about here, that 320 line, 320.40 or what is it exactly? 320.74. I have a hard time just thinking that we're just going to just miraculously melt up. What you could even see is you could see a push into tomorrow, right? And then after you see that push for the window dressing, they just dump on Monday. And that wouldn't be the first time that we've seen something like that where they buy for a day and then you just see the reversal. But at the same time, look, just because it's happened 3 times before and it's worked does not mean it's going to happen this time. If it was that easy, trading would be a heck of a lot easier than it is. And we all know that this is not an easy profession. So we want to keep that in mind. But if we look at the volume, you've had very light volume in here. Except the past 2 days, you start seeing more buying and more buying. And that's really interesting that you're doing that into GDP and that you're doing that in the PCE tomorrow. I just don't know how long you want to be going into this, but we are seeing some signs here. Semiconductors, here's the SOXX. And these were my notes recently for the Alpha Traders community. And what you're seeing right in here, you can see that little blip and we're over and then we tried and then we tried. Triple tops are rare. Now, my note right here, resistance is 440. We're over. Above the major trend line, here's your major trend line. MACD crosses down. So at the time of printing this, I had this specific day right here where you have Tuesday where we were rolling down. And let's just zoom in on this for a second so you can see it. So it looked like on this day we were going to cross and we were going to have an issue. And what did it do? It did the exact opposite. And then it started getting stronger and now it's starting to get wider again. So the question is it going to roll back down or is it just very simply, that's it? It's going to come down, test, and now we're going to push higher. I don't have the answer. I do know that this is a pretty critical level for not only the Nasdaq, but for the semiconductors. One of the things people really need to wrap their head around is if you go out 52 weeks, which would put you right here. And it would put you back in March, but that 52-week, that's a 52-week high. So if I told you that in 2023, we're going to be hitting 52-week highs in NVDA, you would tell me that I was crazy. We couldn't possibly, we're going to collapse. This is why multi-generational drops. Right, we all know how negative the sentiment was, and we're going to talk about that. I'm going somewhere with this. You look at this level and then realize that how do you think the world's going to react, and how do you think the retail trader's going to react when NVIDIA is hitting 52-week highs and they didn't buy it? Right, they're going to rush into these names again, and you're going to see a whole other level to these names. And I think that's exactly what we're starting to see. In front of us is the panic euphoria model, and I'm using 10 years, and right now it's giving me to the 24th. And I'll tell you right now that there's no way that this is lower because of what's going on, but they'll reset it by tomorrow. Now, if you look at these levels and you can see right up here where you were on 210, you start seeing how they work you down and where you're at right now at the end. And you see this peak right down here on 1230 and how that peak ties in with the market, right? And that little dip right there. Now let's just zoom in and do 3 years so we can see this exactly. So here's my lower low. Here's where I am on the market. Here's where the market is right now. And here's where I'm at. So we pretty much are at the same level in the index. And then we don't have the same amount of fear. So my concern in looking at this is, where's the panic? So we don't really have any more panic than we had in the market January 30th, 23rd in. As a matter of fact, I think it was the 23rd. It was around Christmas time. And we were watching NVDA and Tesla implode. And then we rally up, then we come back down. But if we take another step back and look at this and go, how many times are we below this level? After we pop over it, how many times are we really below there? Well, here's the pandemic, and you can see the reversion when we started to trade back over it, right? And I think that's important. Sure, you have these little blips down here, but you're at 2018 levels here, and we're looking at a banking crisis. Go out 10 years and take a look. Where are we again? Well, we don't really have anything more for 10 years for where we're at. Go out 15. Okay, so now we're back into the great financial crisis, this repo crisis, a pandemic. Go out 20 and take a look at this. And you've only been down here 4 times. Now, every single time that you've been down here, what are you noticing? Well, you're noticing that it's pretty much the area where you want to be a buyer, right? When these things have these little peaks, if you're looking long term. Now, this video is not about looking long term. I'm trying to get you to focus on what exactly is happening right now. But I think you have to just kind of go through these and look at them a little closer, and you'll start to see a pattern. And when you zoom in and out, it starts telling a little bit more of a story, right? So if I'm not going to hit a lower low, and the chances of the market hitting a lower low from the December low are pretty rare. Now, if we look at what has happened in the bond volatility index, and we're all aware of this index. We've heard about this ad nauseum lately, right? And I just want to point out what I think is somewhat interesting. And I mentioned it yesterday, but I really want to just make sure people get this. See these levels that we're going to mark? I'm going to give you 3 occasions. So if we just take a look at this, this is going to be Monday, October 8th, right? This is going to be Monday, October 6th, 2008. This is going to be Monday, March 9th. And then, of course, we're going to have here. And I do think that we should just note again that we are above what? We are above the pandemic levels, as they tell us there's no banking crisis. So we can already see that there's a divergence here. Now, that fear that we're seeing, that's what I want to discuss. So this is right around this date, was right around here, where we had that spike and move. Then we just kind of take a look at, well, we know when the pandemic happened and we know how that went. But let's just mark it off anyway, just so we can see this, okay? So that's the second level of the move, right? Then we would just take a look at, well, where are we now? Well, we're right here, okay? So this called the bottom, not exactly. There's no one's going to ring a bell, right? I mean, it's not going to call the bottom exactly, but within the next week, and you go out about 10, 12 weeks, okay, you retest, and this was the great financial crisis. And then you go and take a look at the pandemic and realize that it just called the top of the pandemic or the bottom of the pandemic through the fear in bonds. Then you look at where you're at right now. Now, why this is so critical is we have another discrepancy. So here we are during that period in time, and we can see the reading the panic euphoria model, and you can see how you're down all the way down here, right? You're so much lower. It's like a negative 0.34, I believe. And then you start looking at these other spots, and then you go, okay, well, here we are at a negative 4.6. Okay, well, where are we right now? Okay, negative 2.2. And we're at a higher level on the move index than the panic and euphoria that we have, right? So that's a discrepancy, because if there's so much fear in the bond market, why isn't that correlating with the market itself? Now, this is the VIX weekly. And every time we've been getting down since 22, we get down to this level. We see something. This is March 28th. 2022. We're just mark these off. That's August 1st. It's not going to be exact, right? And then you have November 28th. And then you kind of look at where you're at right here on January 30th, right in there, okay? So you see these marks right here. And then we mark off the index. And we put those red arrows right where those green arrows were. And what we're going to see here, and what I'm hoping that you see, is that there is a massive correlation between when the VIX gets here and how this plays out. Now, this is in direct correlation to what goes on in move, but move is not coming down as fast as the VIX. So something's off. Now, in front of us is the smart money, dumb money indicator. And we don't call it that. We call it institutions, and we call it retail. Now, if we're going to zoom in on this and study it, because there is a divergence here as well, and maybe this can answer some of the questions. So this is 3 years. Let's just do a year and take a look. Now, we could argue that this was the most net short that retail has been in the market since here, which would have been around December 19, right? And then they bought into this move and they've done exceptionally well since October, selling and buying. In my opinion, they've done better than institutional money, right? This is where they were net up and they were selling into the biggest rally that we've had in about a year. So now what are we seeing happen? Well, we're starting to see, quote, smart money or institutions get out, and we're starting to see retail get in. And this is something that we have to think about, because this is what happened back here. Okay. And when this happened back here, the market just went higher, even though institutions were getting out. Now, I'm not suggesting the same thing's going to happen, but what you're seeing is that this is really showing a net short position of retail investors, meaning that they're very bearish here, more bearish here. You're more bearish here on the retail side than you were back here. And that's pretty critical. You'd have to actually go back to the October, November area to find a spot where they were more bearish, and rightly so with the regional banking news. Now, if you look at the way we're rolling here and how that's coming in, and we can just go year to date and zoom in on it even more, and you can see, and then you can see how you're right in here, right? Now, once they're there and now they're rolling, now what? Now we take a look at them and now we try to make a more informed decision. Are these going to cross again? What did this cross do? Did it do anything? Not really. I mean, I thought it might do a little bit more. I actually brought it up. If we look at that 310 date, we're going to get to that in a moment and see how institutions picked up for retail. Is retail going to pick up for institutions? It's like the boy putting his finger in a dam. It's just not possible for retail to stop trillions of dollars. What it can do is it can slow it down. But what's interesting to me is while you have a double top right here on what smart money's doing, right? You can see that double top. You look at here. You never got back down to that level. So in other words, we never retested our level here at the same time this formed a double top. What's that tell you? It tells you that you're seeing short covering on the retail side. And it means that they're also going net long. Now that you understand the convergences that are going on and the conflicts that are going on, you have to look at your signals and determine what are you trying to do. Right? So I can point out what's going on in the weekly chart. I can put out where you are in the VIX and that this is supposed to happen. I can show you on move that this is going to be the bottom probably in a month, right? Based upon historical data. A couple things. It does not mean I'm right. It means that these are data points that we have to look at. Just like when we look at this and say, oh, well, we're calling the bottom because of this. This is out months. This is not out and saying, oh, by tomorrow, because of this, we're going to be here. The same reason that you have to start going through these other charts like the Nasdaq, when I pull this up and drop this in and you look at it and go, well, I have to pay attention to this, but I don't need to act on it. So you have all these conflicting signals. So what I'm going to suggest that you do is you understand the time frame that you're trading in. And if you take nothing else away from this video, you need to understand your time frames. And I'm going to give you a great example here. Now, BABA is something that we started buying in the newsletter around 93.5 and actually had some pre-market trades around 92. To get the newsletter link in description, this is an example of a recent we're doing here is just very simply going through the indexes, marking key levels. We also throw in ideas that you can see that we've done in the Alpha Chasers community, such as NVDA. You can just see also what we're going to be focused on and where we're going from there. And then there, from time to time, I actually put in private videos, link in description. Now, the purpose of showing this is what is my time frame? Well, my time frame, the day of the news, was to get in the trade and up in the trade. So we get in the trade, we do quite well with it that day. We watch it form this little bear flag like it's going to break, and then it never does and starts trading up. Now, my time frame for the day here is to get up and in that trade. But what I know, because I've been doing this for a little bit of time and I've seen this happen before, is I know that this company is talking about spinning off 6 different divisions in an IPO. I know the only way that you have a chance of getting these at the IPO price is that you need to be in this. So we know this. We know that they had their conference, and then this morning they announced that they're going to spin off their first IPO. And this is exactly what I mean by time frame and trying to understand exactly what's going on. My time frame on this is out months or years because I want to be in here for that entire move. I want access to all 6 of these that they're going to spin off. And the only way that's going to happen is if I own this company. But the day that I bought it, my time frame was much shorter. I was looking at 5-minute charts, 15-minute charts, 1-minute charts. But as the trade develops, and I allow it to develop knowing my time frame, I have to look at other areas. I have to start saying, well, got to make sure that I clear this area up here, 120. That's been a problem for about a year and a half if we go back. So my time frame will extend out the longer that I'm staying in something. For example, you start looking at that weekly time frame, you wouldn't even think twice about holding that, right? Because it depends on your time frame. And in this example, I plan on holding this for a period of time. VKTX is one that we talked about, and when this news first came out, it looked like really good news because they did better than we all expected them to do. 5 minutes in, actually we did it off a 1 minute bar. But the important part about this trade is not where we entered, but it was the thought process. In other words, get up and in and then put the stop behind it. And again, we did this off of 1 minute. And then what you're doing is you're waiting for the story to develop. We were waiting for the secondary to hit because you know that companies that have zero in revenue are always going to do a secondary when they have good news. This company was no different. But our ability to understand that this was going to be oversubscribed let us know that when they realized their allocation today, well, once they got their allocation, they weren't going to be happy, meaning the fund managers, and they would have to go into the open market to buy. And that gives you a completely different chart now because now you're extending out your time frames. And now you're seeing these 3-bar patterns, 1, 2, 3, breakout, flag, breakout, right? And then you have your range right here. And look at this today, flag and a breakout on an hourly. So now your time frames have changed. In other words, you've gone from a 5 minute to now we're into a 60-minute time frame. And now our catalyst is behind us, right? So in other words, the secondary catalyst was the overhang. You have good news, so you really don't have another overhang. Now you just have fund managers that are out of position waiting for the next piece of news, and this is your high. So you start with your time frames and you figure out what you want to drill in. For example, if you're day trading or you're trading for a couple days, you really don't care about this weekly chart. You might want to know where you're at, but if you're day trading, you might want to know that you have this sell signal here because that might put you in a position where you're going, wait a minute, I have an exhaustion, because that's what the mark is, exhaustion signs. So whether or not it holds or not, usually it will slow. So if you have an exhaustion sign here, then what you're going to say is, okay, well, I know that I probably don't really want to be buying breakouts unless they're news-driven names like BABA, VKTX. So I want to be buying the dips and then selling into the rallies. And understanding where you are in that time frame will allow you to look at names like NVDA and say, well, when we get to supports or previous resistance, let's see how we do. And then you start to see how it's acting. This one obviously was rejected. This one obviously held. And this allows you to get into these names. And we are seeing it everywhere. Here's Meta getting to that 205 level. If you take a look at where we got to the other day, right down here, go straight across to that close and just look at how close you got to that level. You held in here that whole time. And then on that sell down, you were just unable to get through all of that. And understanding where these levels are and why those levels are important, this is how you would be playing those names right now because you understand your positioning in the market. This is really important for us to go over. You have the high yield corporate bonds that look like they're breaking out. So I have MOVE that is at highs, right? And why MOVE is at highs, the spreads on these bonds has not changed. Here you are right against the 200, but look at the close. You're right back here. So why are we not seeing these bonds sell down if we're putting ourselves in a position where the market's going to come in? And this is what I'm getting at. You have a ton of discrepancies going on. So what I would suggest is I would just keep watching where they are putting the money. And it's very clear where they're putting the money. They're putting it in Meta. They're putting it in Netflix. This is where they are putting their capital. They are putting it in Apple. Anything that is a mega cap is seeing huge inflows, and I would expect that to continue. Reminder, PCE tomorrow, so you're going to really want to pay attention to that. 8:30, you're going to get a real clear indication on which way this market's going to be leaning. Make sure you remember to look at your key levels, not only on the indexes, but on the stocks. And I would consider the idea of buying the dips and buying supports and selling into the rips. Trade to win.